$15 million. That is the number Congress just made permanent to protect your family's money. And when you heard it, you probably felt something loosen in your chest. Finally, your life insurance is safe from the taxman. But depending on which state your driver's license says you live in, the number that decides what your family actually keeps is not 15 million. It is 1 million. Same year, same law, same family. And the most common fix for that gap starts a silent 3-year clock that almost nobody warns you about until it has already run out. Start with the words, so nothing here stays vague. The estate tax is a tax on everything you owned, added together, measured on the day you die, before a single dollar of it reaches anybody you love. Your house, your retirement accounts, your savings, your cars, added up once at the end. The exemption is simply the amount you are allowed to pass on before that tax turns on. So when the One Big Beautiful Bill Act set that federal exemption at $15 million per person, $30 million for a married couple, permanently, with no expiration date and no countdown to a smaller number in a few years, that sounded like the end of the conversation. For most of the internet, it was the end of the conversation. Here is the part that should have made you suspicious. According to the Tax Policy Center, under exemption levels like these, fewer than 1 death in 1,000 in this country results in any federal estate tax at all. Fewer than 1 in 1,000. That number was already tiny before the new law. The law made it tinier. Sit with what that means for a second. The tax that just got fixed permanently with headlines and press releases and 100 law firm newsletters explaining it was a tax that was never coming for your family in the first place. It was already missing more than 999 people out of every 1,000. So why does the second one, the one nobody wrote a celebration post about, still catch ordinary families completely off guard? Because that $15 million number only shields you from one government, the federal one. There is a second estate tax, and it does not live in Washington. It lives in your state capital. In 2026, 12 states and Washington, D.C. still charge their own estate tax. 5 states charge an inheritance tax, which works differently but ends the same way, with somebody writing a check before the money reaches your family. Maryland manages both. The new federal law did not touch any of them. It did not raise their thresholds. It did not soften their rates. They sat exactly where they were on January 1st while the federal number went up, and almost nobody noticed because the good news was so much louder. And in some of those states, the number is not measured in 2 commas. It is measured in 1. Oregon starts taxing estates at $1 million, not 15, 1. And here is the detail that turns a bad rule into a slowly tightening one. Oregon's threshold is not indexed to inflation. It has not moved. Every year that home values rise, every year a retirement account compounds. That $1 million line sits perfectly still, while more and more ordinary families drift across it without doing anything differently. Massachusetts draws its line at $2 million, with a credit that effectively holds the first $2 million harmless. Massachusetts used to have something much worse, a rule that punished you for crossing the line by $1, and the state removed it in late 2023. Credit where it is due. That one got fixed. But Massachusetts kept something quieter. It does not automatically let a surviving spouse inherit the unused half of the couple's state exemption. Hold on to that, because it matters later, and it is the reason this trap is so hard to see coming. Then there is New York, which does something almost nobody explains correctly. New York's basic exclusion for 2026 sits at $7,350,000. Comfortable on the surface. But New York does not phase in gently the way the federal system does. New York has a cliff. Go past 105% of that exclusion, which in 2026 means about $7,717,000. And you do not simply get taxed on the amount above the line. You lose the exclusion, all of it. The entire estate becomes taxable from the very first dollar. Read that again as math, not as language. Crossing that line by $1 does not cost you tax on $1. It costs you the shelter on $7,350,000 all at once because you were $1 over. There are very few places in the American tax code where a single dollar does that much damage. Most people who live in New York have never heard of it. Now, the question that ties all of this to the policy sitting in your filing cabinet. Most people assume life insurance sits completely outside this math. It arrives income tax-free, so surely it must be estate tax-free too. That assumption is the trap, and it is the single most expensive misunderstanding in this entire subject. If you personally own the policy on your own life, the tax code says you have what it calls incidence of ownership. You can change the beneficiary, you can borrow against the cash value, you can cancel it tomorrow morning. Those powers are what ownership means, and because you hold them, the policy is yours, and what is yours goes into your estate, not the cash value, not what you have paid in premiums over the years, the entire death benefit, the whole payout, the number printed on the front page, the number your family's counting on, gets added to the pile on the day you die. A $2 million policy adds $2 million to your estate's math, stacked on top of the house, on top of the retirement account, on top of everything else. In a state with a $1 million line, that single piece of paper can be the entire reason your family crosses it. So run it. Real numbers, real brackets, no hand-waving. Picture a household in Oregon, a house worth $640,000 with $95,000 still owed on the mortgage. A retirement account with $310,000 in it, $65,000 more in savings, 2 cars and everything else a normal life accumulates. Add it up. $920,000. That is below Oregon's line. This family owes the state of Oregon exactly $0 in estate tax. Nothing. They are not wealthy, they are not close to any federal number, and the system leaves them alone. Now add the life insurance policy, $2 million of death benefit, bought 15 years ago in the parent's own name, because that is simply how the agent filled out the application. The estate is now $2,920,000. The taxable portion, the part above Oregon's $1 million line, is $1,920,000. Run that through Oregon's actual brackets, and the bill comes to $196,600. $196,000 owed to a state by a family that owed nothing 5 seconds ago. And notice where that tax came from. Not the house, not the retirement account. The policy created the entire bill by itself. Almost 10% of the death benefit, nearly 10 cents of every dollar that was supposed to arrive as protection, gone to a tax that only exists because of a checkbox on a form nobody explained. Here is where it gets genuinely strange, and this is the part that explains why almost nobody sees it coming. If that parent is married, nothing happens at the first death. Nothing at all. Anything passing to a surviving spouse comes with an unlimited marital deduction, so the tax bill is zero. The paperwork is quiet, and the family walks away believing the system worked exactly as promised. The trap does not spring for another decade or more when the second spouse dies. And because states like Oregon and Massachusetts do not let a surviving spouse carry over the first spouse's unused state exemption, the whole estate lands against a single threshold instead of 2, which means the moment the bill finally arrives, it arrives years after the funeral that made it inevitable, to children who never saw the policy get signed, in a state whose rules nobody in the family ever read. Nobody connects the tax notice to a decision made in 2011. The cause and the consequence are separated by so much time that the trap looks like bad luck. So you reach for the obvious fix. Get the policy out of your name. Financial professionals do this with something called an irrevocable life insurance trust, an ILIT. The logic is clean. The trust owns the policy instead of you. So when you die, you did not own it. You held no incidence of ownership, and there is nothing for your estate to count. That part is true. It genuinely works. This is not a loophole, and it is not aggressive. It is one of the oldest, most boring tools in estate planning. But irrevocable means what it says, and the price is real. You cannot change the beneficiary anymore. You cannot borrow against the cash value when things get tight. You cannot cancel it on a bad month. If you keep any of those strings attached, the tax code still treats the policy as yours, trust or no trust. And you have paid a lawyer for a document that does nothing. That is the honest cost of the fix. Real control has to leave your hands and land in somebody else's. And now the part almost nobody explains before you sign anything. Here is what almost everyone believes. The trust is the fix. So the day you sign the transfer, is the day the problem goes away. Here is what the tax code actually says. Signing the transfer is the day the problem starts counting. Because there is a difference between buying a policy inside a trust and moving a policy you already own into one. And the tax code cares about that difference enormously. If you already own a policy today and you transfer it into that trust, the law does not let you erase your ownership just by moving paperwork. Under Internal Revenue Code, Section 2035, subsection A, the moment you sign that transfer, a 3-year clock starts running. Die within 3 years of that transfer, and the entire death benefit gets pulled straight back into your taxable estate. All of it. The trust is treated as if it were never there. 2 years and 364 days is not close enough. Does that mean an irrevocable life insurance trust is a bad idea? No, it is still one of the oldest and most reliable tools in estate planning, and for a policy the trust owns from the beginning, none of this applies. The problem is not the trust. The problem is the transfer. In the 3 years, nobody starts the timer on out loud. Think about who that rule catches, not the reckless. It catches the person who read the headline this year, felt a flicker of doubt, called an advisor, did the responsible thing, signed the transfer, and then had bad luck with timing. The exact strategy that was sold as the solution becomes worth nothing at the precise moment the family needed it to hold. And it fails in complete silence. Nobody sends a letter when the 3 years start. There is no notification when the clock is running and no confirmation when it finally clears. The policy still exists. The trust document still sits in the drawer looking official. Everything looks handled. The only people who ever find out are your heirs, and they find out while settling your estate, while they are grieving at the exact moment when it is far too late for anyone to do anything about it. So picture that ordinary family again. Nowhere near wealthy by any $15 million definition. A house, 2 cars, a retirement account, and a $2 million policy bought when the kids were small, sitting in a parent's own name, simply because that is how the paperwork got filled out at a kitchen table 15 years ago. On paper today, that family looks completely safe. They are nowhere close to the federal number. Nobody in that house has ever thought of themselves as someone with an estate tax problem. They did nothing wrong. They did not gamble. They did not get greedy. They did not ignore good advice. They bought protection when it made sense, paid the premium every single month for over a decade, and never had a reason to revisit whose name was on line one of the application. That is exactly who this trap is built for. Not the careless, the responsible ones who assume that doing the right thing once meant they never had to check again. There are 2 honest ways around the 3-year clock, and both of them matter more than the headline you saw. The first, instead of moving a policy you already own, the trust applies for and buys a brand new policy on your life from day one. You never owned it. There was no transfer. Section 2035 simply never applies because there is nothing to pull back. The cost is real, though. A new policy means new underwriting, new health questions, and a premium priced at the age you are today, not the age you were when you first bought coverage. The second, if the existing policy is the one that has to move, that same section of the code has an exception written into it. Subsection D says a genuine sale, for full and adequate consideration, is not treated as one of those 3-year transfers. Some professionals structure it exactly that way, as a real purchase by the trust at the policy's fair market value, rather than a gift. It has to be a real sale at a real price, backed by an actual valuation and not a guess, and the trust needs the cash on hand to pay for it. There is one more wrinkle worth knowing before anyone sells a policy to anybody. Selling a life insurance policy can trigger a separate rule that makes the death benefit taxable as income, which is a spectacular way to solve one problem and create a worse one. Structuring the trust so that does not happen is standard, well-trodden work for someone who does this professionally. It is also exactly the kind of detail that gets skipped when a transfer is done in a hurry. Neither door is complicated once you know it exists. The trap was never the tax code. The trap is not knowing which door you are walking through until after you have signed. If you want a simple checklist to walk your own policy against your own state's number, there is a free one in the pinned comment. No email required, no sign-up form pretending to be a download. So before you sign anything, whether it is a new policy, a change of ownership form, or a transfer into a trust, ask 2 questions out loud to whoever is helping you. First, does the state where you live charge its own estate or inheritance tax? And where does your policy's full death benefit land against that number? Not the federal one? Not roughly. The actual number for the actual state. Second, if an existing policy is being moved into a trust, has anyone accounted for the 3-year rule? And if so, how? Is the plan a new policy, a documented sale, or is the plan simply hoping you live long enough? Notice what neither of those questions is about. Neither one asks whether you have enough coverage. Neither one requires buying anything. They are only about whether the protection you already own and already pay for has been sitting quietly exposed since the day you signed it, without anyone mentioning it out loud. Most families never ask because the federal headline made the entire topic feel finished. It is not finished. It moved. It moved from a number with 2 commas to a number with 1, from a federal form to a state form, from a rule everybody was talking about to a 3-year clock that starts the moment somebody hands you a pen. You were told the tax trap got solved this year. Half of that is true. $15 million is real, it is permanent, and for almost every family in this country, that particular fear is genuinely gone. But the trap left behind is smaller, quieter, and far more likely to actually reach your family, precisely because it is the one nobody thought they still needed to check. 1 million, not 15. 3 years, not 0. Same year, same law, same family. The difference between the families this catches and the families it does not is never money. It is 1 afternoon, 1 phone call, and knowing which of those 2 numbers is actually yours. You know both of them now. That is the